The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast. I've got Rich Posson back here to talk about what's going on in the world of economics. Rich, how you doing this morning?
Good, thank you.
I guess before we get too far down the path, let's talk a little bit about your podcast and where people can find that.
Sure, go to criticalpoint.podbean.com. That is the host of all you'll see is just videos and audios. And you can sign up there, and there are some that I put out for free. Most of it's locked up. And then you can also go to criticalpointpod.com, and that's my homepage. And that's where you'll learn about my self-models, occasionally do a little blogging. And there's also links to the videos and audios. And then if they want to contact me, they can contact me on X at Rich_Posson. They can also email me at rich@ag-financial.com.
Right on. Okay. Well, a lot of stuff going on, Rich. We've seen a lot of movement here. We've got a lot of different things turning some cranks that I didn't necessarily see happening. So we've got the Fed came out last week and said, "Hey, we're not gonna change the rates right now. I think a lot of people are anticipating that they were going to do something just based on the economic numbers that we saw and where job creation was, and the various other models that they're looking at. And Chairman Powell said, "No, we're gonna pump the brakes on this right now. We're not going to do anything. We're going to wait till September and look at September and possibly do something in September." As you look at this, Rich, were you surprised, one, by what the July meeting said, and two, do you feel like September will see some changes in the interest rates?
I wasn't really surprised at the Fed not wanting to move. I was actually a little surprised how strong the stock market is. Fortunately, I made a little short-term quick trade, and most of my subscribers were probably able to catch it quick enough that we thought it would bounce the day before the Fed and on the day of the Fed. And yet I was puzzled when he was speaking. I started contacting subscribers saying, I feel like fading this means sell into this strength. And it's just for a short-term trade. I'd already made a more important sell signal in July that has worked out very, very well for us. So it was just a quick trade to the upside and then turn right back to the downside, because I was sitting there and I'm watching how the market's behaving. And it was like 90% of the up move was done before Powell even got to speak. And I thought, gosh, I'm not so sure they're going to buy anymore. And I'm listening to him. I'm reading the notes out of the FOMC meeting, or the text, not the true notes. And I said, I don't see any reason to get excited here. I think they're going to wait to September by the sounds of this. And the market was just like, it just sat there going into the close. They did sell a little bit at the last minute, but it was mostly, it was almost like they were stunned of, what do we do with this now? And then, so anyways, I was fortunate enough to say, even though my model hasn't triggered this little short-term sell yet, I'm willing to sell into this. And then overnight and the next day, the model said, sell it. And then it's like everything just broke loose. I really think they had a reflection point of when they were saying, maybe Powell's speaking the way we want, but it's not quite there. What do we do with this? And then once somebody started selling, everybody else started selling. It's like, oh, Jack's running out the door, so let's run with Jack. And then it just fell apart. And I was very fortunate, quick trade up and down. But I want to point out to people, we had a far more important sell signal in late July. I had 2 or 3 sell signals along the way on the way down here before most of this drop. And I may go ahead of my model and even buy some today just because I like the price. It's been beaten up a lot, but the model it doesn't have a buy signal yet. And problem is the model's got a debate now. Buy signals from now all the way into early September, meaning they may go down all of August and we get the buy signal late. But I am looking for reasons for it to come in sooner here, because sure, they've sold after the Fed. They came to the conclusion, the Fed didn't really give us what we wanted after all. And they saw some of those economic indicators coming out after the Fed spoke and saw the jobs report, which may have been skewed by the hurricane in Texas. So we may see those jobs come back quickly. And so they may learn they overreacted on that jobs. But it was just one thing piling on another. And I want to point out to everyone, during August, October, on average, it's a slippery, messy kind of type of a time of year for stock markets. We know this going back 100 years in history, 20 years, 50 years, whatever you want to use. And with that messiness means some shocking downside. And I was nervous there, I think the week of July 18th, or it was July 18th, I triggered the first sell signal right near the top, very close, almost sold the exact highest price. And the reason was the model was picking up signs, gosh, they're already starting their August, October selling. They're starting it in late July. So people were anxious. People were nervous. They didn't want to lose all those wonderful profits they made all year long here. And it was just one thing layering on top of another, because now we have Japan, their stock market's down 27% in less than 2 months, which longer term, that doesn't bother me. They'll be higher later in the decade. But shocking moment for them. And it's understandable. My model did call for a long-term top, fairly close to the top as well. So it was on top of it. But yeah, everything just came at one, like all the people who were thinking of selling the next 3 days, 30 days, next 300 days, they all came in at the same time, and bam, the market had no place to go but down. But when you see these straight down, blood curdling moves, quite often they're buys. Where the true bear market's going to last a long time, sneaks up on everybody, it frustrates everybody, goes down for a while, slams up, goes down again. It's just something about it. These very fast moves are not a sign of a bear market. So I want to be cautious because I do have some signals, types, indicators here saying we could have problems all the way into next year. But at the same time, there's conflicting evidence that things are going to be okay. The economy really isn't falling apart. So I think the Fed lowers a quarter point in September and will be relieved and life goes on. And if by chance this market takes a nosedive for the rest of this month, and I do not believe it will, but my model's warning it may, it's still on the table, I think they'll lower a half a point to send a message they're serious of putting the brakes on. But right today, I think the Fed internally gets nervous over these markets dropping, but most of the time they tell themselves they're not in the business of the stock market. They're in the business of interest rates, the economy, their mandate. They're dealing with Congress and the government and the Treasury. And last night I listened or watched an interview with Bullard, who used to be on the Federal Reserve Board. He quit last year. He's now teaching at a university. He's the dean even of a financial section at a university. And he just said, he basically said he was sorry to say it in a way, but he felt this drop in the stock market was just the stock market being the stock market, meaning he just could not get on board of making a big deal of this. And he just felt like the Fed is not going to be pushed into an emergency rate cut. But I'm telling my subscribers, let's keep an eye on this because they could do an emergency rate cut anytime during the day or night now into September. And I'm going to err on the side of immediately buying, even if my model's not buying, because that could put in a significant bottom and it just keeps on going. It could be just a short-term bottom, blips it up, and then later they get nervous of, wait a minute, why is the Fed doing an emergency rate cut? What else do they know? What are they? I could see it being a two-edged sword, that by making the rate cut helps on one hand, on the other hand, it may scare people on a short-term basis a little bit. But I think the best forecast is let's try to hang in there, be optimistic here. I realize there's negative things. The model's been warning these negative things are building, but it's also warning those negative things will go away probably during the first half, if not the first quarter of next year. And the real trend of the stock market is actually up next year and some of the following year, and even longer than that. But that's one fluctuation I'm looking at, is up into 2026, and I believe the economy grows in 2026. Now, the election may also throw us some curveballs that's coming up here. But I think in general, yeah, the economy, some businesses aren't making the money they used to, but it's not like this plague that all companies are falling back. I mean, we've got other companies that are just waking up. They haven't made $1 in 2 years. They're just waking up. And so really what the stock market is trying to do is shift around, saying, okay, I got to dump my high flyers, my big money makers. I got to buy some of these sleepy stocks over here and the sloppy stocks, because eventually we will get interest rates down, life goes on, and those stocks are going to be the better performers. But it's causing short-term problems of how this money's flowing in our stock market. So that's where I'm at.
I got one question for you quick. You said something about in 2026, the economy was going to go from there. What did you mean by that? Like, do you feel like in
2026 to 2027, I'm looking for a standard correction in the stock market and the economy.
Okay.
And what I mean by that is the stock market may only be down -7%, -11%, but we have to allow as much as 20%. And that would be normal. That would be normal behavior inside of a much larger bull market and economic growth until about 2030.
Okay.
So that's what I'm watching for. So my thoughts are, even though things could get weaker than I think in the next few months, maybe we could also get a -20%. I seriously doubt it. We got the NASDAQ down 11% or more. That's meant my better targets. We got the S&P 500 now down 9%, I think, 8%. That's met my targets. I think that's good enough, and it's going higher into 2026. Then you get a bigger setback for who knows what reason. I'm just looking at how the money flows, how the economy grows. There'll probably be a setback there, okay? And even then, that won't be an end of the world scenario. Anybody's looking for the best sell signal per decade, I think you got to wait around 2028, 2031. We'll get a recession, primary cyclical recession, down minus 20 to minus 50%, maybe a little more if the debt implodes, which I do not believe it will. I don't think anybody can predict that. And I think it's a long ways off yet. I think we could still print a lot of money and have a lot more debt, but we probably shouldn't do that. The day's coming. I think we should get more serious about, in my opinion, if I could run the country, I'd tell the people, okay, we're going to get serious about trying to figure out on this national debt. And we're going to run a lot of what if scenarios. We may even spend $1 billion on research figuring this out, but we don't have to do anything this decade. But we're going to have the plan. And when the plan is done and we agree on it, we're going to take action. And as long as we take action by next decade, I think there's a good chance we can make it work and we'll be all right in coming decades and for future generations. But we don't have to do it today. And for some of these politicians out there that are showing us their plan and they want to do stuff literally overnight, that's probably actually going to cause a problem first, even if it will fix things longer term. It could cause a disaster. We could be that sensitive to things. But I don't think it's going to happen. So to me, I've been right for 30 years saying nobody can predict when the country's going to fall apart because of debt. They've been wrong. And as I look at the history of other countries, they've been wrong for thousands of years. So, but I don't want to take away from history that does show some countries really imploded, may even disappeared just because of too much debt. We know you can have too much debt. I get that. I'm just saying for this country, it's just been too difficult for these people to predict. They've been getting as bad as the people predicting the end of the world. Well, granted, the end of the world's probably going to come, but maybe not in my lifetime. And they've been wrong for a few thousand years. And that's why I'm at debt. I want to get more serious about it, and I will talk more about it now. But I don't, and even then, I have to recognize that if people want to get scared about that, it is going to clip the economy and the stock market, but it doesn't have to come true. And yet at the same time, stock market will go down. So I don't want to miss out of that either. I'll do my best not to, I don't want to be gung-ho optimistic here all the time either. The market's going to trade, and it's going to trade bad news, even if it's not the right bad news, So we're in a shaky time this time of year, but I must say this morning I'm feeling a bit more comfortable. The stock market, since it's dropped straight down 10%, it feels like I want to be brave here and buy something, but I don't know how much because it can always go lower. But we do want to think about what else in the world can bother us. We know the Middle East can still blow up some more. I still don't think that's enough to crumble the global economies, but who knows? And we still have issues with China. We're going to have issues for years to come now. I mean, this trade war stuff isn't going away. And if they get a chance to suddenly run in there overnight, they'll probably take over Taiwan. So there's lots of those things. But some of this stuff also is very difficult to predict, and you kind of got to focus on what's going on in our own country. And right today, our country's doing well enough. The economy's doing well enough. Some of this construction stuff's coming on. Manufacturing, last week's report scared some people. They didn't like it. To me, it's not been a good indicator. Last 2 years, worst performance in 50 years of actually meaning something. And with all this building for manufacturing, I think that's someday going to really make that better. But yesterday we got the services PMI, and that was in the positive territory, suggesting a growing economy, it greatly improved the internal factors. And I went out on X and all these chat boxes to see what other people are saying. And they were saying they were pleasantly surprised how well the services snapped back here recently. And they were already doing fairly well anyways. So that does tell us a significant portion of the economy last month really was doing well. So let's not forget about that. Now, again, that can change on a dime too, but we want to be cautious of being overly scared here. I think they overdid it on the stock market. The dollar has come down quite a bit with this concern. It's rebounding some now. I think in the next 2 or 3 weeks it bottoms, rebounds a little better for a month or two. But I got to tell you, something I'm working on for my subscribers here. I do follow the Bloomberg dollar index, and I think it's doing a little better job of picking model-wise, picking tops, long-term tops. I think we got a lower dollar in the next year, and I think we got lower interest rates in next year, and I think that's going to help our economy and stock market will be okay. But right at the moment, I do think the market is getting tired of waiting on the Fed. So it's getting more sensitive to the Fed not telling us what we want, or getting more sensitive to any negative news of making a bigger deal out of it than it should. And I hope the Fed's waking up to that. It's not going to be pretty if they don't lower rates in September, okay? And I'll be ready. If I'm buying now, I'll be ready to sell in a hurry if that happens. But yeah, I think we're going to be okay here. And we probably ought to talk about this Japanese yen trade here, because
So I was reading some articles about that, and I've never heard of this before. So they were talking about a thing called a carry trade, and basically what people were doing were borrowing money from out of the Japanese Bank of Japan, out of the yen, and bringing that yen back to the United States because the exchange rate was so great that they were making money both ways, investing that money into the U.S. stock market, and then that's kind of that we saw some of this fueling of this last big up run that we saw there. Well, contraction in the market we're seeing now, we're seeing actually some really good movements on the commodity sides. As you look at the last couple of days, the last couple of weeks really kind of ebbs and flows there a little bit. But I guess explain what that means and why that is such a big deal.
Yep. So on the carry trade, you're right. They're buying the lower interest rate currencies, selling the higher rate insecurities. They're trying to get a spread. It's kind of like the carry in the grain markets, of which most people can't. Most people can't really do it unless you're in the cash grain business, but they can do it. The little guy can do that in the currency markets, in Forex. They're basically just playing that spread. The problem is they also have the risk of the currency itself changing, so they could lose more than they're gaining out of that. Some of these people aren't just playing that spread. They're actually doing that and then taking that money and buying stocks and bonds and real estate. They're trying to make an extra buck out of the currency trading to finance their actual investments. So the problem is this has gone on for at least 20 years because basically Japan hadn't done anything for 30 years on their interest rates, their economy. They were dead in the water on inflation, their stock market, their interest rates. They've been at 0%, it seems like forever. And now they're suddenly up to 0.5%, which is to us is nothing. We're thinking, oh, that's not a big deal, right? But it is a big deal because these people, these banks, especially the big time investors, the professionals, have bet so much money on this kind of thing and have financed other investments that suddenly, especially for the youngsters, it's rather shocking, okay, of what's going on here, of changing this whole carry situation because of what's going on with interest rates, their inflation, and the printing of their money. So this is making some people nervous, and the dollar has weakened against the yen here over the last 2 months, considerable amounts. I think it's down from 160 to 145. And they're not used to that kind of characteristic here all that often in the past 5-10 years, and kind of shocking the market a bit there. And what it does is it concerns stock market people. Is this one of those things that turns from a contagion instead of being a banking system thing and a currency investor thing and a bond market thing? Can it also impact other financial markets, specifically stocks? And then when they saw the stock market in Japan drop 27% in less than 2 months, it just did this. Right. It was up over 10% last night. I don't know if it actually held those gains. So that was a quick snapback. So that also piled on top of this weakness we're seeing now. And so it's about the mechanics of currency. I don't know if it's really a good clue of economies or anything like that. It's a lot of banks and hedge funds playing games there. But boy, they play games. Some of these hedge funds, when they can actually gang up on a country and cause that country to spend a lot of money to defend their own currency. And that's worrisome to me. I'm not the fan I once was of hedge funds. I have a hedge fund myself, but honestly, I could care less if I make it bigger. I'd rather have individual accounts for everybody. And I just feel like the hedge fund it's not providing value to the American people anymore, and may yet cause some problems and breakdowns in systems. So I get that, but again, it still looks like Japan has, in my opinion, a solid enough economy there that I'm not that concerned. I think their stock market will be higher in the next few years. It'll be more in line with ours. They had a very good run, the best run they've seen in a while. It's understandable they're going to take profits, and they took profits, but it kind of got away from them relating to some of this currency business, this carry trade, interest rate concerns, inflation concerns. Okay. But for the moment, my modeling is not like sending out this red signal of, oh, don't buy Japan. In fact, maybe we ought to worry about ourselves. I don't see that. I don't think it's going to be a contagion.
Yeah. Okay.
But it's something to watch, something we got to keep in mind.
Let's jump over and talk about commodities real quick. So if you look at the commodity market, it's been, we had a pretty dismal week last week, beginning of, 2 weeks ago. Last week, we saw some really good runs up. We saw, 3 in front of December corn. That bounced back. Now we're kind of hanging around that 402 to 405 range of December corn. We're looking at this morning, soybeans took off and ran. You've seen some movement in gold. Oil's kind of stagnant, kind of bouncing around there a little bit. As you look at the commodity market as a whole, Rich, what are your thoughts?
Yeah, I don't think the oil market's going anywhere until late winter, early spring, when it'll probably will try to bounce into summer for the gasoline season. Quite often, it actually is going down during the summer driving season, so I have to watch out for that. I don't see any major shift there, but I do think over time things will tighten up a little bit. I can get a little more bullish on oil late 25 into 26. I like this oil price right now. It's good for our economy. It's good for the stock market. I can allow it to go up $5, even $10 a barrel. Won't bother me a bit. It can drop another $5 to $7 a barrel, and I am leaving the door open for that in the next few months here. But I don't think that's a negative for the economy. It'll be a positive, okay, because it's just cheaper inputs. So I think it's just a short-term trader's market. I can't get too excited either way there. And I don't think it's giving us any major clues. It did drop the last few days because they're a little nervous. Are we going into recession? But again, my model's saying no, we're not. And the Fed probably will lower the rates. And you can see oil starting to stabilize. When we look at some of these other commodities, I'm actually kind of surprised how right I was saying sometime 23, 24, we're going to start down in those major commodity indexes and be down into 2025 and then maybe up by 26. That's been working very well for me, but unfortunately, I kind of split the grains out from that. And then I said, I don't think they're going to be that bearish. And then they turned out to be that bearish. So it's been rough from there on me from the grains from that perspective, even though the overall commodity sector, it's actually been behaving the way it should. Here's something I'd like to point out. This may be a little experimental, but I have this theory, some of these hedge funds beating up on commodities. It was part of that play of anti-inflation, but it also was part of the play of getting the economy back to normal. But it also had something to do with all these high interest rates, where sometimes higher interest rates, commodities will actually go higher. Sometimes they go lower. And I think it made more sense to them. If it's going higher and you're cooling off businesses, you're also going to cool off commodities. And they did it. They won. They were right. They were more right in the grains because we got great crops. And I was expecting a chance for a crop problem, and I'm still in the future here. We'll get it eventually. All that piled on. I got this thinking that when the Federal Reserve lowers interest rates in September or whenever they do, I think that's going to change an attitude of these macro hedge fund players trading commodities. And I think they're going to be less bearish at first. Eventually they will be bullish, but I don't think they're going to be outrageously bullish. I think they're just going to work their way out of the bearishness. I think this provides us to get back to a little more normal supply-demand balance here and how they're trading at least the futures. And I think that puts a floor price in for stuff like grains. And I have a study that's showing corn is as cheap as it was in the 1930s when you adjust it for inflation. I did this in 2005 and called that wonderful bull market up into 2008. That was one of the studies that I just said, this is insane. Nobody should be selling their corn here. This is as cheap as it was when it was 20 cents a bushel or 13 cents a bushel, whatever it was in the 1930s. And it was a nice additional input. I'm not saying that's the reason corn went up. It really wasn't. That corn went up because of the China demand back then. and the ethanol-based demand that all came at the same time and was very explosive. But it helped me establish a floor saying, do not give up, because it was coming down in the last minute for myself too, where I was wondering, boy, is this going to work? I may wind up firing myself. And it turned out it was great. It was wonderful. Big bull run there. And I wanted that record high price no later than 2008. And I remember December 2007, my wife says, well, Mr. Sherlock Holmes, where's your record high price for corn? And I said, yeah, I may be getting a new job next year if this doesn't work out. And because I bet a lot on it and my entire business. And lo and behold, it come to fruition. We got the record high price in 2008 last minute, but the free market obliged me and did prove how these super cycles and the long-term business cycles work in these commodities. Well, we're here today when I can't tell you for sure there's a major bottom here for corn. It can come in. Soybeans might be a few years yet. But what I can tell you, these things are getting very cheap. Corn's cheap enough that this is getting insane. I'm not saying it's a reason to explode. It's not that kind of undervaluation. We do have, the bears rightly pointed out, we got some demand issues here. But I think what it's telling us is telling me, how much more bearish stuff can we possibly invent, So I got to be a little optimistic looking out to next year. And then I still say probably a crop problem in 26. I will say, when I was looking for a crop problem this year, I also warned, the model was warning, it's time for a big recovery in rain, precipitation. And I told everyone, we got to get this bull market here. We're gonna have a problem. Well, the rain came in first instead of the drought side, and we got it, but it still leaves the door open for some issues a little bit next year and even more so in the 26. So I have to think that the things are aligning here for the worst to be over, and these commodity indexes, I think the worst will be over by early next year. And I think some of this might have to do, we're going to lower interest rates. And some of this is also going to have to do with some of those low price stocks, those stocks that people have kind of shunned for the last 2 years. The reason they were shunning it is they really were nervous over those higher interest rates. So a lot can change that can be quite positive in coming years if we can just get that Fed to lower rates. and as we can see these last few days, American people are getting a little upset about this. They're saying, come on, we won this war on inflation. What are you doing, And as I've warned, though, the Fed always, it doesn't mind being late to every single party. So it's their nature. Yeah. It's just their nature.
Never gets there on time, and you're late to everything that you need to go to. So that's yeah.
So yeah, I would have cut by now. Not by huge amounts. I would have just given us a taste of it at least to make us feel better. And I noticed Jeremy Siegel, I respect Jeremy's work he used to be at Wharton Business School, and I think he's retired now, but he's been a bull for decades. It always seems to be a bull, but he does pretty good at manage some of the problems along the way and keeping us tuned in to the major long-term move. And he even came out yesterday, I think it was, and said, yeah, the Fed ought to cut now, But I suspect he's bullish longer term still. And so we're putting up with short-term crap, and the long-term scenario is still there. Okay, and so I got to stick with my plan. I think commodities recover a bit next year. Inflation relative to commodities can bounce a little. I don't think it's going to be scary, a big move, because some of those other things, the non-commodity things, are really starting to break down, speed lower. Some of them are minus, meaning prices are actually lower. They're not that we've slowed how fast they're rising. We've really brought them down. So I think we're in a comfort zone where commodities can move up and not cause a problem in inflation. And I think that's a sweet spot. It's exciting. But I think I do need that interest rate to come down. Meanwhile, looking at the economy, same story. I think that does well to better over the next 2 years. Stock market does better. But I think, and the interest rates will go lower, I'm convinced. But we need that turning point. This is the next piece of puzzle to put behind us here to extend these bullish kind of moves, put an end to these bearish moves, is bring that current interest rate down to the Federal Reserve. And the free market interest rate has come down quite a bit. And people were shocked that the stock market dropped so much because interest rates were also dropping huge amounts. One, people were buying bonds to lock in high interest rates because they pretty much were convinced, yes, the Fed will lower in September. But the bigger move, lowering interest rates from the bond market traders, was also some worries that they were disappointed too that the Fed didn't lower, and worries about this. So it's weird that we brought in people, two different groups of people thinking a bit different here, yet they converged to say buy bonds, push the interest rates lower. And I think the one camp is going to be wrong, but it won't matter. I think they'll continue to buy bonds over time because they'll see eventually the lower interest rate. The other camp is just really betting a little early ahead of the Fed, and they'll be right as well. So what would be fascinating is we may actually see a little while after the Fed lowers its rate, we may see the free market rates actually tick up a little, just because it's stabilizing. It's getting back to its own business, because they probably overshot it a little bit as well. So don't be surprised if the interest rates actually bounce by next week a little bit. To me, that's a return to normal business, and you actually see the stock market go up, which is, you should do the opposite. But it's just because they both went down. Interest rates went down too fast. Stock market went down way too fast. You're going to get these knee-jerk reactions, this kind of rubber band kind of snap back kind of stuff. So now let's hopefully we just don't get any more bad news and deterioration around the world here, and they can stabilize. And I think they will probably buy the stock market going into the Fed Reserve meeting. It's just a question, what day this month do they start? They may not start at the end of the month. There may be some other issues here that we haven't seen that I'm not quite on top of how bearish it could be. But like I say, I'm getting ready to buy a little something here. So even if I got to be a little early, I'll manage it. So
on the interest rate side, one more question on that. I've had people ask this question, and I remember how fast it went up, and I'm, obviously it's going to take its time going back down. But when you look at interest rates, therefore, what, year and a half or something like that, about every month, every Fed meeting, you saw a quarter, point, half point, 3/4 of a point, something like that. As things start to go back down, is your anticipation to see just they're going to ratchet it back slowly, like 1/4% per meeting, 0.5%? Like, what's your thoughts there?
I think it's going to be kind of slow, just because I'm not convinced they're that far behind here. But we'll see what some of this data does. I will say the unemployment rate should be moving higher into September. It could move higher well into next year, but the only way to do that is the Fed really was seriously behind, screwed up, didn't lower fast enough, stuff like that. I think the unemployment tops out around December to March, and that'll be okay. It won't put it up that much, and then it'll ease back. And I think part of the reason is the Fed will lower in September, probably lower at least once more before the end of the year, and that'll start trickling through. And then eventually we'll bring that unemployment rate back down. And I don't need it to come down huge amounts. It's really not that high, but it was a big jump to that 4.3% in the last report. And that scared people a bit there. By the way, the Taylor rule that was created by Mr. Taylor, used to work for Federal Reserve, and I believe he now is a big hedge fund manager. He said his Taylor rule suggests the Fed ought to be at 4% now, not 5.25% like they are now. That's a big difference. So again, I understand that's why it scared some people in the stock market, because even though he just said that the other day here, and the market already dropped, you can bet there were people that were on top of that looking at that kind of thing. So it would be sweet, in my opinion, if the Fed actually lowered pretty quickly, give us 4% by early next year. That'd be something. This stock market is going to soar. But I'm telling myself, because the Fed's known to be kind of slow, if they don't get enough information by that September cut to warn them they really are behind, seriously behind, I think they're going to continue to try to be on the slow side, just like they always are. Okay. And so now the question is, will we see enough information to discourage the stock market that we're not dropping fast enough? And right at the moment, my best picture of that is no, that's not really the case. If the stock market sees them lowering the rate, they're going to be optimistic. And I think the same thing on commodities, price-wise.
Right on. Okay. All right, Rich, probably a good place to stop. Folks want to reach out to you, get more information about your podcast. Where can they find that? And also, how can they get a hold of you?
Yep, go to criticalpoint.podbean.com. You can also go to criticalpointpod.com. Any of those websites will get you to free and locked up videos and audios. And my subscription is only about $28 a month. Okay. And that's pretty cheap compared to my competitors. I've got people out there that I'm competing very well with that are getting 3 or 4 times that amount. But I don't have the staff they have because I don't write a newsletter anymore. And I don't have all these databases for you to look up stuff. You can get 6 months of videos and audios. You can go back and look at that. And I do this pretty much free. I don't try to write out a little script to follow when I do it. I just say it as it is. And I prefer the videos over the audios because you can see on the charts what these model signals were doing. Make a decision. Is it something worth for you? Because I have a broad audience that goes from people who want to know when to buy and sell every day. They want to know, do I think it's an up day or down day? All the way to the other end where people say, well, you probably only need to listen to you once a year because I'm going to buy and sell out for several years and then I'm going to sell. So I have that wide of a range. And I literally have a once a decade buy sell signal. And you want to be on board for that one. It helped me very good in the early 2000s. It helped me in the mid 2000s with financial crisis. And then, boy, and when that COVID struck, I nailed the top within 2 hours in February. And in March, I bought the bottom 2 days after the bottom. I still own investments from then. And that's how much I'm up. In fact, I'm up twice that amount because that's the kind of products I invest in. I'm willing to make twice as much and lose twice as much as what my modeling will do. And so that was one heck of a home run for me. I don't know if I'll be that accurate in the future, but you can bet I'm going to be there working at it as we go into the end of the decade. But right now, I got to be bullish for the rest of this decade. Again, anything could happen. Geopolitics, our own politics and elections could interfere here. But I try to provide ideas for people, what's going on during the month, during the week, during the day, what's going on during the year. But then I want to connect years and give an idea, where are we going during the decade and for the decade. And so it's worked well for me for decades. For people who want to know how long I've been at it, well, I've been studying markets for almost 40 years now. And as a professional, probably 30 years. And I make my own living out of the stock market these days. And so it's mostly about the stock market, the grains, but quite a bit about the economy and interest rates, a little bit on gold, crude oil, a couple of little things thrown in there. And I do have a passion to try to predict droughts and crop problems, which probably is one of the more difficult things to do, but I am fascinated with that as well. So that's what you get for that price. And I've got people that have been with me since the 1990s. So I think it's a good testament of it works, even though I cannot be as right as all the time. I'm looking at myself saying I think I rank in the top 20, 30% of the country, but I don't sign up for any kind of contest or anything like that. I don't need to play games like that anymore. So. But that's where they can get me. And then, if they want to message me, ping me, Rich at _Posson, Posson. And then they can go to Rich at ag-financial.com. Send me comments, send me questions. If you've got a different opinion, if you'll give me an honest and detailed, so, I don't want an opinion of, oh, you're just nuts. Tell me why. And I'll dig into it. And let's have a discussion.
Right on. Rich, appreciate you being the podcast, man. I'll catch you again next month.
All right. Thank you.
Unless something crazy happens, then I'll get you back on here. That could be tomorrow. So
Yep.
Okay, we're going. So all right,
yep.
Well, Rich, appreciate it, buddy. We'll catch you again next time.
Okay, thank you.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. Check out the video version over on the YouTube channel, which is the Moving Iron Podcast YouTube channel. And go to movingironllc.com for everything Moving Iron related, where you can see the information for the Moving Iron Summit coming up here in Nashville, Tennessee, November 4th through the 6th. Interested in that, you can shoot me an email at movingironpodcast at movingironpodcast.com, or you can just go to the website and sign up there. Start time would be 1 o'clock on the 4th and end at noon on the 6th. So filling in the details there shortly as we go through that. Go to TikTok while you still can, and you can check us out over there. I don't know where they're at on that, Rich. I don't know if they're getting ready to dump that or not, but one way or the other, sounds like TikTok's on its way out. So if you want to see us over there, check us out at Moving Iron Podcast. So with that, I'm Casey Seymour with Rich Posson. Smooth Smart, folks. Out. The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. This podcast is proudly provided by Axon, helping dealers move more iron for the past 100 years. Find out more at axontire.com. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time